Hong Kong, despite its size, has more than 1,200 banking branches, one of the highest concentration of banks in the world. By late 2019 or early 2020, there will be an influx of 8 additional virtual banks hoping to make their mark on an already saturated market. But who are they? How are they different from traditional banks? Let's take a quick tour and see what we can learn from virtual banks from the other side of the world. First off though, what actually is a virtual bank? Similar to traditional banks, virtual banks are also regulated by the HKMA. However, while traditional banks use physical branches as their main channel, virtual banks deliver financial products and services without the bricks and mortar. They mainly rely on the online channels to reach their customers. The two also have different target segments. While traditional banks can serve customers across the board, virtual banks will focus on serving retail and SME customers. As this new form of banking emerges, what's the appeal? The answer is simple: their innovation, solving customer pain points that are currently unaddressed by the incumbent banks. Take the average retail customer as an example. Applying for a loan used to mean endless paperwork and countless in-person visits to branches. But WeBank, a Tencent-backed virtual bank in China, has solved this issue by offering 24/7 online express loan withdrawals. All it takes is just a few taps on your phone. For overseas travelers and holidaymakers, cash conversion and travel insurance used to mean a cumbersome process. Now, the existence of virtual banks has resolved these issues. Revolut from Europe offers a pay-per-day travel insurance service, which can be activated when the user is detected abroad through its banking app. As for cash conversion, Zinja from Australia offers free foreign ATM withdrawals and currency conversions. On the other hand, from the SME's perspective, they are generally being underserved by the traditional banking sector, whilst the rise of virtual banks, which offer easier banking access at a lower cost, could be the answer to their prayers. For example, UK-based challenger bank Starling Bank has decided to provide 100% mobile-friendly banking, zero-fee local transfers, and a hassle-free way in linking up the bank account with accounting software. All these customer-centric offerings are meant to attract consumers who might have unsatisfying experiences with traditional banks in the past. After all, a satisfied customer is the best advertisement. And the appeal has proven to be quite astounding. In the UK, the number of digital-only bank customers have rocketed, reaching 13 million in 2019, doubled from 2018, and is expected to hit the 35 million mark by 2020, which accounts for more than half of the total population in the UK. With a major presence online, the removal of physical branches and frontline staffs means the operating costs of virtual banks are estimated to be less than a third of traditional banks. All of these, together with a considerably more efficient IT infrastructure, mean virtual banks appear to be off to a good start. However, the experience of some overseas virtual banks has suggested otherwise. Revolut and Starling, both started 4 to 5 years ago, are still booking losses. Why are they still struggling to stay afloat? What went wrong? As a new entrant to an already saturated banking market, digital-only banks need to invest heavily in marketing to gain a foothold in the industry. As the virtual banking market becomes more crowded and traditional banks begin to invest more in their digital capabilities, customer acquisition cost is expected to remain as one of the main expenses for virtual banks in order to stay competitive. And while products like zero-fee currency conversions and commission-free stock trading appeal to a lot of customers, these cheap payment products have a relatively lean margin, which don't generate much income for virtual banks. To make matters worse, some virtual banks rely heavily on these products and high-cost deposits in their early stages, making it harder to cover the customer acquisition cost and operating expenses. To rectify the situation, virtual banks are looking into partnerships that will give them a lift. With the assistance of partners, digital-only banks could gain quick access to a new pool of customers at a much lower acquisition cost than building a customer base from scratch. Partners can also help digital-only banks to roll out new customer solutions faster, providing new revenue streams and increasing the share of customers' wallet. Revolut, for example, is expanding its business globally to 56 new markets through leveraging Visa's brand, scale, and global footprint. N26 has joined forces with several other fintechs to expand its product reach, including TransferWise for P2P money transfers, Raisin for savings, Vamo for investments, and Clark for insurance. Based on past experiences from around the world, it seems to us virtual banks can cater better to specific customers. However, most are still struggling to stay afloat and have to look into partnerships to remain sustainable. Back in Hong Kong, while we are anticipating 8 new virtual banks by late 2019 or early 2020, these worries remain. At the same time, the rise of virtual spaces has brought with it concerns about data leakage, privacy, and cybersecurity. Data breaches and system errors have caused multiple stirs in Europe, dampening consumers' confidence in digital banking services. Are virtual banks ready for this? How much impact would they bring to us and the banking market? Will they be profitable and sustainable in Hong Kong, with existing competitors continuously raising their digital game? To find out, we talked to a series of financial practitioners, university academics, and management consultants to hear their perspectives on virtual banks in Hong Kong. Stay tuned.